Well, Federal Reserve Chair Jerome Powell says interest rates could climb higher than experts had first predicted.
I think the markets have really underestimated how much is needed.
Rates could go higher, get there faster, and stay there longer than anticipated.
We could end up seeing more hikes and then a deeper downturn.
We need rates somewhere on the order of 6.5–7%.
Jerome Powell just doubled down on his plans to fight inflation, and the stock market isn't taking it too well. And Ark Invest's funds could feel that pain much more than any other fund. In fact, they might be due for another collapse. So in this episode, I'll go over exactly what's going on, what it could mean for growth stocks, and what Cathie Wood has been buying inside Ark Invest funds as a result. Your time is valuable, so let's get right into it. Look, I get it. You're probably just as tired of hearing about inflation as I am of covering it. But it would be a big mistake to stop talking about inflation, and an even bigger one to think that interest rates are all priced into the market right now. Here, let me prove it to you. This is a plot from Bloomberg. The red line is the core CPI, so it's the consumer price index excluding food and energy. The gray lines show the consensus inflation forecasts by economists over time. I don't think I've ever seen a more embarrassing plot in my life. There are two big takeaways here. First, these so-called professionals never predicted high inflation in the first place. You can see that each gray line hardly goes up at all. As a result, inflation is regularly 50, 100, or sometimes even 200% higher than economists predicted. And second, they expect inflation to fall much faster than it has been. In fact, their predictions on how fast inflation will fall only get faster and faster over time, even though inflation is clearly coming down slower than most people expected. My point here is actually really simple. Everyone keeps saying that inflation and the Federal Reserve's response are already priced into the market. But how can that be when even the Federal Reserve itself can't predict it, which is why they've been adjusting their target for interest rates literally every single time the FOMC meets. And guess what? With new CPI data coming in next week and the next FOMC meeting the week after, I expect their target rate to change again. But don't just take it from me, I think it's important to hear these things straight from the source. So here's a quick clip of what Jerome Powell just said a couple of days ago when he testified in front of the Senate Banking Committee.
My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. The breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. There is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
One thing I really appreciate is that Jerome Powell is always very clear about what he's seeing in the data and what the Federal Reserve intends to do about it. The latest CPI data showed little signs of slowing down, with the headline number coming in at 6.4% and core CPI coming in at 5.6%. But the year-over-year numbers don't really tell the whole story. The most recent month-over-month data saw inflation climb by 0.5% thanks to price increases in rent, gas, and food. So inflation is showing a worrying amount of staying power even as it comes down from its peak. And January's jobs report showed an unexpected surge in hiring, adding 517,000 jobs. That's almost double what was added the month before and a little less than triple what the market expected. As a result, unemployment fell to 3.4%, which is the lowest that it's been since humanity landed on the moon. We'll see what the next job report says in just a couple of days. But for now, high inflation and a strong labor market mean that the FOMC could end up raising rates higher than expected, raise them faster than expected, and keep them higher for longer than expected. And like I just showed you, we shouldn't assume that that's already priced into the market. That's why it's so important to diversify your investments with assets that don't correlate to the stock market. And Masterworks is a great way to do just that. That's because they're the only platform that lets you invest within multi-million-dollar paintings without breaking the bank. I like Masterworks because according to a recent report by Citibank, art had the lowest correlation to the stock market of any major asset class, and contemporary art prices have more than doubled the S&P 500's total return over the last 26 years. Masterworks has an impressive track record of 11 exits, all of them profitable. With the last 3, investors realized a 10.4%, 35%, and 13.9% net return. With those kinds of results, it's no wonder that Masterworks has a massive waitlist to join. But right now, they're giving you VIP access to their latest offerings. I'll leave a link to that offer for you in the description below. Alright, whether you're talking about art, or real estate, or stocks, good investing comes from making good decisions in context, not in a vacuum. We've actually covered a lot of context so far, the latest inflation and jobs data, as well as the Federal Reserve's latest stance on that data. That's important to cover because Cathie Wood is taking the exact opposite side of that bet. That means that she thinks inflation will come down faster than expected, and the Fed will slow down or even lower interest rates much sooner than even the Fed is currently projecting. Cathie Wood was on CNBC a little over a week ago to explain the big trends that she sees in the stock market and Ark Invest's current strategy. Here's a quick clip of the highlights, which will give us all the context we need to talk about her most recent trades inside Ark Invest's funds.
So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down.
So you see these most recent hawkish hand-wringing as, the death gurgle of inflation? One last attempt to try to make its voice known?
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
It was looking like that in January, but then January data all came in really strong, including inflation, with the PCE going in the wrong direction. So the market has sort of changed its mind from your view and now thinks we're going to have a series of more interest rate hikes and they're going to have to stay higher for longer and the economy is going to get hurt worse than expected.
Yeah, this is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long term were the winners.
Some people look at your Ark Innovation Fund, Cathie, as a barometer for what the Fed is doing, right? And they say it's back on the rise, speculative behavior is back, unprofitable tech companies are getting bid again, the Fed has more work to do.
You know, it's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust and people fearing that we may be in the same situation. We are not. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
So Cathie Wood thinks that the stock market is already starting to price in low inflation and interest rates falling accordingly. But CNBC's Sarah Eisen made a great point. The S&P 500 actually agreed with Cathie Wood at the start of the year when it rocketed up almost 10% in a single month, and the Nasdaq actually went up by over 15%. But it's just now, finally, starting to price in that 5.25% federal funds rate that the Fed told us that it was aiming for back in their December meeting over 3 months ago. So here's another data point showing a huge lag between what the Federal Reserve says and what the stock market ends up pricing in. And the Fed might raise their target rate again in just a couple of weeks. So here's the big question for investors. Is the market pricing in lower future interest rates, like Cathie Wood is saying? If so, then the stocks that she's buying now could be big winners in the coming months as the market continues to price in lower and lower interest rates. But if the market is actually lagging the Federal Reserve because it doesn't believe their predictions, then Ark Invest funds may collapse even further as investors catch up to the Fed and start pricing in even higher interest rates. Alright, now that you have both sides of the argument, let's take a look at how Ark Invest's top holdings have changed since February 2nd, which is when both the S&P 500 and the Nasdaq hit their year-to-date peak. Here's the table of their biggest position changes when you combine Cathie Wood's 6 actively managed funds. Each row is one company, the rows are ordered by the size of Cathie Wood's position in that company, and each position is colored by its change in size over the last 6 or so weeks. Since then, Ark Invest's assets under management fell by $1.2 billion, or about 8%. So, positions colored in green shrank by less than 8%, and positions colored in blue shrank by even more than 8% over the same time frame. That means that the green rows are the positions that Cathie Wood increased relative to the rest of the funds after seeing the latest inflation data. Keep in mind that there are 2 ways for her to increase the size of a position. She can either buy more shares, which is shown in the change in this first change in shares column, or she can hold shares instead of selling them as they go up in price, which obviously grows the position size, but adds in the risk of the stock's price going back down as the Fed responds to new inflation data by raising interest rates. I want to respect your time, so I won't read the whole table out to you, but let me point out a couple of trends in the data. First, besides Coinbase and Roblox, most of the dark green rows are that way because the stock went way up in price, and Ark Invest didn't sell enough to bring the total dollar amount back in line with the rest of the funds. That makes sense if you expect stocks like Tesla, Roku, Twilio, and DraftKings to keep climbing higher. But it adds in a lot of risk if you think that prices are going to go back down after the next Fed meeting. Second, let's sort the table by the change in total position size, so that the darkest green rows are on top. Changes in position size should correspond to changes in conviction, since these funds are all conviction weighted and managed by the same Cathie Wood. So, Twilio, Accolade, Roblox, DraftKings, and Kratos Defense have all grown in size relative to the Ark Invest funds, because Cathie Wood didn't sell them as they rocketed up by 10 to 20% in price over the last few weeks. So, if these stocks drop in price, they'll have an outsized impact on Ark Invest's performance. Likewise, if we look at the stock Cathie Wood let drop in price without buying the dip, we can see another pattern. Twist Bioscience, Invitae, Ginkgo Bioworks, CareDx, Insight, Pacific Biosciences, Beam Therapeutics, Teladoc, and Verve Therapeutics can all be found inside ARKG. So it looks like Cathie Wood's conviction in genomic stocks has gone down relative to the other innovation platforms that she invests in, like artificial intelligence, robotics, energy storage, and so on. And all that makes sense given the massive AI breakthroughs that we're seeing with tools like ChatGPT, which might not benefit genomics as much as they benefit the other platforms. Alright, hopefully this episode clarified the Fed's latest comments on inflation and interest rates, Ark Invest's current stance on the market, and what both positions could mean for growth stocks in the very near future. And if you find this content valuable, you can help me out by filling out a quick survey that I'll link for you in the description below. That way I can understand what kind of investors and tech enthusiasts end up watching this channel, which lets me make my content even more relevant to you. I really appreciate it. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to share more research like this. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.